Hi and welcome. I am Christina Sewick, Windermere Sun Capital Partners here in Phoenix, Arizona. I hope everybody out there is staying cool as we hit a record-breaking 118 yesterday. Hope that you can enjoy some air conditioning wherever you are at and can get out to some nice lakes and cool off out there. All right, so let's jump into the housing market. We've hit some relief. We've hit some relief from the last time that I joined you last week on Friday. Mortgage rates have come back down to under 7%. And I think that's a critical number. I think as we jump over 7%, I think that that's sort of a mind block for a lot of buyers. It's just too far away from where we were in 2021. Okay, so let me share with you. I love to go to the Housing Wire for information on the housing market. So they say we finally got a break in mortgage rates last week as the 10-year yield hit a critical level and quickly reversed lower, sending mortgage rates down. Active listings showed growth week to week, but at a much smaller rate than we would like to see. Purchase application data showed some growth weekly, keeping alive the streak of more positive data than negative data year to date. Weekly active listings rose by 5,569, and mortgage rates fell from 7.12 to a low of 6.87%. The recent high was 7.22. Mortgage applications were up 2% from week to week. So as you can see here, when we were here last week, when we got up over 7%, the 10-year yield really came up really close to that number, up in 4%. And I think we were even over it for a period of time. Here's 4%. We were up there we were up over 4%. And today we are back under 4%. And that is due to the CPI numbers came in as expected. So we're tracking latest inflation data bodes well for mortgage rates. The CPI data released today shows the growth rate of inflation cooling off, and that's a good sign for mortgage rates. If inflation were running hot like it were in the 1970s, mortgage rates would have easily gotten up over 8 to 10% last year. That fact, the growth of rate of inflation has been falling over the last few months, is a positive story for mortgage rates in the long run. And here's a sheet of where nationwide, according to Morningstar, where households have the percentage of households have their interest rates. And this is from the BAM network podcast. Love to tune into the BAM network and watch Byron Racine every morning. If you don't, you should. He runs the hot sheet every morning at 9:30 Pacific time, I believe. Okay, so mortgage rates, people that have rates that are 4% to 5%. There's 20% of the people that have mortgage rates 4% to 5%. And I think this is important to hone in on because we've kind of had this standoff of people not wanting to sell because they don't want to lose their rates that are under 3%. And we can see those that have mortgage rates that are under 3% is 26% of the population. Those who have mortgage rates from just over 3% to 4% is 44.7% of the population. Those who have mortgage rates 5.1% to 6% is 5.3% of the population, and greater than 6% is just 3.7% of the population. So this is what's creating the standoff as far as why would I want to sell and give up my mortgage rate that is largely, under 4%. That's what the majority of this here can show you. So at what point in time does the mortgage rate today have to get down to making these people that have the rates under 3% and under 4% and arguably even under 5% want to move? As an industry, we've been saying, if we could get down under 6%, that we would see a larger majority of the supply wanting to move. So just something to watch. I think 7% right now is, like I said earlier, is that breaking point number. It seems that if we get below 7%, more people are willing to go ahead and make the move. Because again, it's about making sure that you're comfortable with your payment. And that's what you should primarily focus on is, are you comfortable with your payment and do you love the house? The rates often change, and there's been a lot of prediction. Granted, nobody has the crystal ball that sometime in 2024 and the beginning of Q1, rates are suggested or proposed to drop below where they are now and perhaps get into that high 5% territory. Of course, nobody has the crystal ball. So again, if you love the home and you're comfortable with the rate, I say go ahead and buy, because nothing seems to be pointing to the market. I don't like to use the word crash, but crashing. Statistically, as we spoke about last time, we just don't have the inventory. So let's go to this graph. This is from the Cromford Report, and I love the Cromford Report here at Phoenix. I subscribe to it. And they say over 57% of resale sellers in the greater Phoenix area have owned their home for more than 3 years. Property values have appreciated 40% or more over that time and are maintaining. The level of buyer demand continues to be fueled by sellers' ability and willingness to contribute to rate buydowns. So again, here, let me pause. That's helping. Those rate buydowns can help with your mortgage rate. They can be used to buy down a point, and your lender will be able to explain to you more how that can benefit you. But again, those people who have owned 3 years or more, now they are sitting on a considerable amount of equity. If you've owned in Phoenix 3 years or more, and maybe they would be in the camp of having a rate under the 5%, but maybe since they have so much inventory, they'd be more willing to sell and to help assist the buyers. So 42% of June closings involve some form of closing cost assistance from sellers, with a median cost of $8,000, with the prime price point being sales between $200,000 and $500,000. That same price range happens to have 20 to 30% of sales over asking price as well, with the median being $5,000 to $5,500 above list, reflecting many buyers' willingness to meet the sellers halfway. So I like this market right now for a couple different reasons, but I like it for buyers because you can have an inspection. You always should have an inspection. And I think that's something that's always maintained here in the Phoenix market. It's been different in other markets, but inspection, huge. You want to have that, of course. And then you also want to be able to negotiate some of those inspection items that are found. If your home needs a new HVAC, or if there's some other thing that your home needs, you want to be able to negotiate that with the seller. And this market, largely, you're able to do that. And then what this is saying too is that sellers are willing to meet, buyers and sellers are willing to meet each other halfway and negotiate and perhaps use a percentage point to help buyers bring their rate down or help the buyers with closing costs. So that's why I like this market. I do. Okay, so the Cromford Report, again, love the Cromford Report. And here we are looking at, so what cities are favoring more sellers? Cities that are favoring more sellers are going to be green, and cities are favoring more to the buyers are going to be red. Now, anything over 100 is still more in the seller's favor than the buyer's favor, but we're just talking about change month over month when we're looking at the Cromford Market Index. Okay, so for example, the cities that are in most benefit right now for sellers are Buckeye, Chandler, Paradise Valley. They're all up more than 9%, moving in favor of sellers. Now, those that are moving more in favor of buyers are Cave Creek, which is down 23% from last month, Glendale, which is down 18% from last month, and Tempe, which is down 20% from last month. And then this is the supply and demand index. So this is what I'm talking about. We have not a lot of demand, which is this here. However, we have more demand, as you can see, than we do supply. So that's right now that has been kept the prices hovering at the same or perhaps going up. Granted, I will say that when the mortgage rates went over 7%, that we had less of demand in mortgage rates, less volume happening with mortgage applications. Again, I think that 7% marker is sort of the defining number. It feels like from our data where buyers say, I need to just wait to see what happens to see if we can get down under 6%. That said, the market's so volatile right now. Again, if you like the payment and love the house, I would go forward. So this is what's keeping the market right now, prices stabilizing and prices not going down, is that we just have more demand than we do supply. So again, see here, we're above the market index, we're above 100, so we're in favor of the seller. Mortgage rates, what are they doing? So mortgage rates, as we talked about, jumped a bit. They jumped a bit higher last Friday after triumphantly dropping during the first 4 days of the week. That bounce back may have cast some doubt on the level of triumph, but things have remained calm at the start of the week. So we're still calm starting this week. The average lender right now is in line with rates seen on Friday, which is substantially lower than the rates the previous Friday, the last time that we had our live here. In fact, the average lender is still roughly 0.25% lower versus what they were on July 6th and 7th. While the bond that underlies the mortgage rate movement will likely be mulling some big decisions in the coming weeks, there's a bit of a lull between now and the next big batch of big ticket events. It's not that this week's scheduled data is incapable of causing volatility, just that the odds are lower when compared with things like next week's Fed announcement or the several of the economic reports being released in the following week. So the Fed meeting for July is going to be on the 25th and 26th. So as we approach this, and definitely this week, we want to be watching, what happens if the Fed is going to go ahead and raise. Is it going to be another quarter point? Is it not going to be? I think we're hoping that it's not going to be, not going to be raised anything, because it seems like as we started, inflation has been getting better. Our data came out that the numbers were getting better. But I still think personally that the Fed's going to go ahead and raise another, hopefully no more than 0.25% basis point. So let's just see what rates are today. We ended up the market today, 6.90% is our rate today. And you can see that on the banner too at the bottom of the screen. And let's see, since we're so closely tied to the 10-year treasury, we were at 3.803% to end the day. We opened at 3.805, so not that much of a change. And our high today was how we ended at 3.809. Is that correct? Oh, no, it ended at 3.803, and our day low was 3.797. So just remember that right now in the market, let's see if I can get right now, the market is extremely volatile, and it is still a standoff between sellers and buyers to see where the next move is going to make. Is there something where the rates are going to come down? And that's going to cause more buyers to jump into the market. But I caution you, as we've spoken about before, when rates come down, more buyers are going to jump in. Supply, as you have seen, is still very low, and that could cause another frenzy to where prices start to go up. So again, I know I've said a couple times in this program already, but if you like the house, love the house, and are comfortable with the rate, I would say go ahead and make the move and purchase the home. All right. If you liked your content that you've heard here, please click subscribe and like, and please follow me at Christina Seawick. All right.